Bruce Richards, the Marathon Asset Management CEO and Chairman, and he joins us now. Bruce, good to see you.
Hi, Alex.
So I wonder, have we finally re-rated? Like, is the least dovish option now finally priced out of the market, and the markets and the Fed finally on the same page?
It's, I think what you said opening, like there's nothing to see here. Nothing to do in March, nothing to do in May. First cut in June 12th, and probably 3 cuts this year. And what's going to surprise the markets is not the 3 cuts, because they've already priced down from 7, 6, 5, 4, and now they're at 3. They're finally where the Fed wants them to be, and what I've been saying all along, 3 cuts. But what's going to surprise you next is the Tennessee two-step. And what the Tennessee two-step is...
I was like, I don't know what that is.
I know you love your country western, because you know your daughter and you are Swifties now, and so you love your country western. What the Tennessee two-step is going to move 75 basis points, and then he's going to wait 4 meetings over 6 months. He's going to wait and see, did the stimulus of lower rates do anything to reignite inflation? Did it do anything to re-stimulate GDP? And if it did, they have more to wait for, but it probably won't. And so after that first move and after that pause for 4 to 6 months, which no one's talking about in the marketplace, then it can resume bringing rates down to 3%, where I think it eventually gets to Fed funds. So it's like when you went from 0 to 5.25, it was like driving from, I don't know, since we're talking about Tennessee, it's like driving from New York to see the Grand Ole Opry in Nashville, right? But on the way back, on the drive back, really relax, really
lots of rest stops.
We'll have a dinner tonight. We'll stay at this hotel. We'll go see some friends in the morning. You know, before we continue on, and that's what it's going to be, the two-step.
That's actually a really helpful way of looking at it. Now that I know what the two-step is,
I'm going to steal that.
So we're definitely going to steal that. So based on that, where are the biggest dislocations that Bruce sees opportunity?
Well, first of all, I got to remark how amazing the credit markets are, and how amazing of a job Powell's done, because here we are with higher rates, and despite equities being relatively flat, they've been screaming. And so imagine the economy doing as well as it is, that the fixed income markets have done as well as they have, and it's all doing quite well despite what is higher rates. And so, you know, what's the opportunity here with this type of environment? Well, I think first it starts with credit, because it's higher for longer narrative, higher for now, and then when even they cut, higher for longer later too. And that's really amazing, because we earn, like, you know, SOFR 530 plus 500, 600, 700 basis points on a lot of our private credit investments. These are double-digit returns. We've never had it good, all of us private credit lenders. And in the credit markets as well, high-yield leverage loans, emerging markets, structured credit, we're earning some really nice cash flow and rates return. So we love that, and I'd start with that.
Well, what about those certain pockets of that area right now? Because we talk about it from the umbrella basis, and the return or the potential returns are certainly there. I don't know if the real estate crisis, if you want to put it out in quotation marks, was ever resolved, but we do know there is still a bit of a refinancing cliff coming up for a lot of commercial commercial landlords, I should say, and particularly in the office space.
So let's break it down for you. So there's about $21 trillion of value in commercial real estate, $21 trillion throughout the country, okay? But there's a huge debt problem. But you know something? There's only $5.6 trillion of debt. So when you think about it, there's 2 worlds. There's a world of $13 trillion of commercial real estate that doesn't have any debt on it, and they're laughing. Their valuations are down a little bit, but they have no strain, no stress, not losing any sleepless nights, nothing. Then there's $8 trillion of real estate that's levered up with $5.6 trillion of debt that's been provided to by various sources. And those folks are having a real problem, because they bought in, these are the financial folks, at the big, brilliant fund managers and real estate owner-operators that use leverage to buy real estate. We all know who they are, and that's the world we all live in, okay? And those folks are sweating it out, because valuations are down 20%, in some cases for office, 30, 40% or more, right? Valuations are down, financing costs are up, and the cash flows aren't there to support the amount of debt they have outstanding. And so there's multiple things that begs. Number one is the banks. So you have all these banks, and like the top banks in this country, you know, the top 30 banks don't have a problem. The big banks that really matter don't have a problem. They only have 10% real estate exposure. But it's the other banks, and there's a few hundred of these other banks, the smaller and regional banks, that have like 40% real estate exposure and in debt. And they're the ones that you're going to see have the problems. And they're the ones that the FDIC, silent in the night, are going to come in and resolve those banks.
So based on that scenario, do you embrace this sector from an investment perspective a little bit more, or just kind of stay on the sidelines and see what
Oh,
happens?
absolutely embrace. There's, you know, 1,500 different CM, waiting for this moment. You're right again. 1,561 CMBS transactions, 9,000 different tranches. We have them all modeled, and we've been in buying the tranches that are dislocated, number one. Number two, we're buying loans from banks and from, you know, the REITs and providing some liquidity at discounts, of course, on some of their best assets because they sell their best assets first. Number three, these capital relief trades the banks need because of Basel III endgame coming. And finally, we're a lender, maybe last resort, but a lender at these higher rates on viable commercial real estate projects, whether it's development, whether it's refinancing, whether it's a new acquisition, and we're making really, really high rates returns on these loans relative to what one made before, because a lot of the folks that are out there are impaired, buried under some of their portfolio, the workouts, and not in a position to be able to be a lender. So, Romaine, to your question, we love this environment. It's going to be tough for a lot of owner-operators, but we're going to help through a lot of projects that need, that extra capital to make it through, and we're very comfortable in that position.
So before I let you go to that point, didn't we just see that article where someone sold an office tower for like $1?
Yeah, so 360, you guys heard about Bloomberg.
Yeah, exactly.
So 360 Park Avenue South, 22, I think it's 22-story building, 500,000 square feet roughly, and the sponsors bought it for $300, let me make sure I got my math right, $300 million of equity. They put $100 million of CapEx into it to completely refurbish and rebuild out all the floors. So now they're in for $400, and they've put $15 million of debt service in it. They're in for $415 million, and they have $200 million of debt against that $415. The sponsor, the lead sponsor that owns this building, just flipped it to his JV partner for $1, just so he doesn't have to fund additional capital calls because it's burning cash to keep it going. And so, yeah, that's not one story. That's one of 1,000 stories that are going to play out these next couple of years. Because to your point earlier, Romaine, and here's a big point that no one's talking about, is we came into this year thinking 2024 would have about $540 billion of refinancings. Maturity walls. And the MBA, the Mortgage Bankers Association, just printed a number of $900 billion. How do you go from $540 billion to $900 billion? Because it means a lot of the loans from last year didn't get refinanced, just got extended, amended, extended, or as you like to say, Alex, amend and pretend.
Yeah.
I say
you say that, or I say that.
Okay, you say that.
I say that. And amend and pretend into this year. So now the maturity wall is even bigger and more daunting than it's ever been.
And that's why Bruce is so excited. Bruce, hey, thanks for coming in. We really appreciate it. Come back next time. Bruce Richards, Marathon Asset Management CEO and Chairman.